From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on 3 key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts. But Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full-year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year. Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the Sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.